See if it works. Okay, let's get into it. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. Hey guys, how's it going? This is episode 4 of the Amateur Investors Podcast. We got questions from the audience this week. First question coming in from Dimple: how to invest and buy stocks without spending a lot of money when you're still learning?
Yeah, that's a super important question to ask. I think there's sort of a few schools of thought about like how you get started investing. I think there tends to be this like thought that there's a barrier to entry about like how much money you have to have before you can even get started. I know a lot of brokerages have historically had a minimum deposit. Some still do, but there are so many alternative avenues to go about just putting in a little bit of money to get your toes dipped into the water of investing. And so we'll talk about that. And the other school of thought is that you have to dump in a ton of money or like a bulk of money for investing to begin. I think with Robinhood, you can really just put in $1 and create like a fantasy suite of companies, whether it's 15 or 100 companies. You can just put in $1, buy $1 of each company, and you have a really great portfolio. And then my other suggestion is not to put in a ton of money all at once, especially when you start learning. I like to think of the early dollars of investing as sort of like the tuition in the school of investing. Start small, and by having only like $1 or $2 in each of these companies, Robinhood supports fractional shares. So you can buy 1, to 50% of a share on Robinhood, and you don't have to be fully invested into these companies, which might be expensive for your budget. But this is a nice way to kind of dip your toe into investing without having to front a ton of money. So the Robinhood fractional shares allows you to have bits and pieces of companies. And then as you get more comfortable, you can kind of add to that portfolio as you go. So I'm a big fan of the fractional share feature.
Yeah, I know my uncle, he still uses a brokerage, which is kind of more of an archaic way of doing things. But I know his broker, I think anything that he wants to purchase, it's either $50 or 0.5%, whichever number is larger. So the brokerage is making money at the end of the day. So if my uncle were to, invest $10,000, it's, 0.5% of that investment, or $50, whichever one is larger. So if he's only buying, $1,000 worth of stock, or, $100 worth of stock for, let's just say, one share, it would be $50. But if it's, a large amount of money, he gets 0.5% of whatever it is. So I think Robinhood and technology and just kind of millennials in general are kind of breaking the bounds of a lot of different industries, but especially in investing with Robinhood coming out that there is no commission fees, there is no brokerage fees, and, definitely use that to our advantage. I know they are limited with some of like the charts and even a lot of like the analysis. I know Ben and I are not the fondest people of Robinhood's charting. Yeah, I look at it, but I much rather use like a Yahoo Finance or Google Finance or, other websites to just kind of compare and contrast long-term trends and stuff like that.
Yeah, there's definitely a trade-off to, and I wouldn't say brokerages are necessarily archaic. I think Robinhood still is going to have some growing pains to grow into the robust analysis of like just legacy brokerages. Like I use Charles Schwab for my Roth IRA, where I'm just doing like ETFs and funds of that nature, because I really just want to stick it, set it and forget it. It's my retirement fund. I just want it to be a consistent strategy, which is the same as my Roth or as my 401k. So I think Robinhood needs to build up into that level of detail, because they really did disrupt the industry, like you said. All these brokerages are now following suit with the zero $0 commissions, $0 trades.
Yeah.
So I think Robinhood really has changed what it means to be an investor and like what that looks like. But again, the trade-offs, you need to think like, where are you in your investing and finance careers, like for personal investments or even professionally? Because the Robinhood is as absolute bare bones as it gets at this point. And I'm sure that they're, in order to be competitive with like Charles Schwab, you can set up personal stock screeners. They'll give you the news. They'll give you all their stock ratings. Robinhood it feels more like almost like a social media more than like an analysis tool. So that's the trade-off just to be aware of when you're thinking about like investing. Robinhood, if you want a really involved research platform to do your investing, again, use that fractional share, only put in a little bit of money with the idea that you're going to transition to something else. But it's a really great learning tool for the early investor. I still use it a lot just because I'm there, but other tools are out there.
Yeah, definitely. And like I said, I know Ben and I have kind of touched on this before. When I was calling them archaic, I guess I was just talking about they hadn't really innovated. Robinhood was the first really to come into the space and innovate and zero commission fees. I still use T. Rowe Price and Charles Schwab for two different 401ks that I had at previous companies as well as my current company. And, investing I kind of look at is like, it's more like it's a strategy. We're always talking about that. I know for my 401k, I'm always putting away 10% of my salary into a 401k to get the benefit of the match for my company, as well as Robinhood's more of like, I guess not my gambling money per se, but it's more of like my for fun money. If it were to go to zero, I'm not hindering my retirement. If I make more money, I can maybe retire even earlier. But, if that were to go to zero, like I look at all of my investments as if they were to go to zero, would I be okay with losing it? I know we always talk about tracking the S&P 500, and historically over the time that the S&P 500's been around, and in any 20-year period in history, even through Great Depressions, recessions, anything you look at, the S&P 500 from one point in time to the end of 20 years has always come out ahead. So if you look at it like that, not to say that anything's a safe investment, but just looking at that, is reassuring that you could look at any time in history through the Great Depression, the crash of 2008. If you look at 20 years, it'll always come out ahead of where it was. Some returns will be better over those 20-year time frames, but you will be making money in the long term, and that's kind of one of the points of investing. I know three other things I want to talk about are Betterment, Wealthfront, and Acorns. I don't really know Betterment and Wealthfront as well. I know Acorns is basically you can set it up with your account, and let's just say you were to go to Chipotle to get a burrito and it's $11.50. They'd round up that 50 cents to $12, and that 50 cents goes into an Acorn account where it automatically starts investing. And you can pick your portfolio if you're looking for short-term games or short-term investing, long-term investing, or I forget what the last one was. I don't know if it was dividend-based investing or I think income-based investing, I think.
Like a fixed income thing?
Yeah, the mixed income. So I think those are the three different aspects for it. But yeah, Ben, I don't know if you want to talk about Betterment or Wealthfront or Acorns at all.
Yeah, I think so. I can't speak too much about Wealthfront. I think if you know Betterment, you know Wealthfront. At the end of the day, I know that some of their like fee structures are a little bit different. Like the rates, I think they're really, really close together. So with Betterment and Wealthfront, they're really kind of flipping the script of like what a brokerage looks like. They offer a lot of similar features. To my understanding, I think Betterment, you can actually talk to an actual advisor through that brokerage. But what that platform is, same as Acorns, they are robo-advisors, robo-investing platforms. So what you do, let's say you want to put in $500 or $50, you invest that money into Betterment as the company, and then Betterment allocates that money across a portfolio. And to my understanding, Betterment does a lot of like really low fee funds from like Vanguard, maybe iShares. And what they do is like they'll give you some exposure to the S&P 500. They'll give you some small companies, some mid-sized companies, some international company exposure. And what's really, really nice about those platforms is that is a way, same with Acorns, it's a way to participate in the market and start capitalizing on some of those returns. One way to do that is just to buy an S&P 500 index fund, which like Chris said, if you were just to pick any point in time over 20 years, you would have came out ahead. But what's really nice with Betterment and Wealthfront is it takes it the next step is they're doing the research, they're doing the analysis on how to best allocate your portfolio based upon your age, your risk tolerance, whether you should be more stocks or more bonds, and then like when to sell to get some benefits on tax. So that's a really, really nice way to participate in the market, and just like that isn't even a step beyond just indexing and ETFing, because all you're doing is sending money to Betterment or Wealthfront or Acorns, and they just do the work for you. So it's really, really nice. If you're like, I want to learn, but I want to make some money, that's a great way to get it going.
Yeah, definitely. And even I know we kind of even talked about it before. There's this thing called paper trading, which is basically like you're not even putting money up front. You're just kind of learning the basics of it. You have the benefit of just using fake money. You know, you're just saying you bought the stock, but not actually putting any capital or money forward to do so. I know TD Ameritrade has one, or I think it's what Think or Swim is a good one as well. So it's fake portfolios that you said you were bought in at this date at this time. So you have, you know, one share or fractional share at this cost, and then you can track it over time. I will say one thing: the biggest lessons I learned is when I had money on the table. I have definitely done paper trading before in the past, but you kind of really learn a lot more when your skin's in the game. You know, it's a lot easier to be like, oh, I made all the right decisions on paper and, you know, all that, but you definitely learn from your losses and your wins when you have money on the table. That's just something. I don't want to say that like, oh, you should put all your eggs in one basket, but definitely making an investment into something, you definitely track it more readily. It's your money. It's actually on the table. And then also, I know Ben was mentioning Google Finance has plugins for Google Sheets, has some really cool tools to track companies. I don't know if you want to explain that.
I think we can do like a screen share one day. I don't really want to do like a deep analysis today, but if you just look up in Google, like a Google search bar, just Google Finance syntax, that'll walk you through how to like go into a Google Sheets and just do like equals Google Finance. And they have like a lot of tools that'll be like, do I want to see the real-time stock price? So you can almost make your own paper trading tool for yourself. I'm a spreadsheet nerd for sure. So being able to plug in this data into your own spreadsheets and track yourself is really nice. But like Chris said, having skin in the game is not, I don't think it's like you're putting yourself at a ton of risk if you're just putting in a couple bucks here and there. But there is something to be said about the psychology of investing. And with anything, with learning, I think comes the psychology of just like your brain's chemicals. If you don't have anything at risk, or you're not, you know, facing any consequence, you don't get that like dopamine kind of like fear response mechanism, because there's something really complex about investing when it's like when you see your account go up, you get a rush of dopamine. You see that green. When you see red, there's like this fear, latent anxiety. So understanding sort of your tendencies about emotions with investing is really, really important. And that's something we definitely need to talk about in our next episode. Mistakes of investing is understanding how your emotions play into your investing decisions. Because at the end of the day, you want the logic and the numbers to override your emotions at all times. For sure.
Definitely. All right. Well, moving on to the next question. Thank you, Dimple, so much for your question. We enjoyed it. It was a very good topic, and I hope a lot of people got a lot from it. So moving on to Christine. How do you trade options? So I'll ask Ben. On full disclosure, I've never traded options. I've done a lot of research on them, but personally, I feel that they're very risky, and you know, they're also very complex. So just knowing myself, that's not something I ever really plan on doing. Maybe I will one day, but as of right now, I kind of know how they work, and they're pretty complex in nature. So Ben, I know you have traded options before, so if you'd love to expand on that topic.
Yeah, and when I I wouldn't say I traded options for an extended period of time. This is like I put in a few bucks here and there just to see what it was like, just because a dangerous thing that Robinhood did in their platform, which I think sort of popularized options to like the layman, is you just click of a button, you now can trade options. Whereas historically you had to apply, you would put in some of your like social security information, they would check your like financial background, history, what have you, to be accepted to options trade. So the difference between, and I'll walk through what options are and like kind of how they work. I'm not an expert at all. I don't do options.
Mm-hmm.
I will one day, maybe. The difference between options and buying stocks is that quite literally what an option is the right to buy or sell a stock at a given price. It's a contract. So the way options work is I will pay X amount of money to own a contract to either buy or sell, let's say 100 shares at a given price by a certain date.
And let that be known, an option is always one option is the right to exercise 100 shares of a company. So you, whatever the stock price is, let's just say it's $5, you multiply that by 100 for $500. If that's you're buying an option to buy it at $5. It's a little confusing, so I'll try and
it is a little confusing. I'll definitely make sure, because I have like an analysis written up, and Investopedia has some good resources there.
Yeah.
So that'll be in the show notes. We'll walk through it. I'll make some pretty graphics. Why options are so risky, in my opinion, is that the difference between an option and owning the stock is you need to be right about the direction of the stock and the timing. So at all times, the options contract is always decaying, the value of it. So it will always go to zero for either the buyer or the seller. Whereas if you own a stock outright, you can hold it forever in theory. Whereas the option, that expiration date will come, and the option will expire worthless if it's not executed. So you have to be right about like whether the stock is going up in a call option, whether you're buying a call option, or going down if it's a put option. So there's a lot of risk in the timing there if you don't fully understand that.
So let's just use a simple example. I'm just going to look up Apple stock because it's just an easy one to talk about. So right now, as of yesterday, the stock for Apple closed at $116.59. If Ben were going through picking an option, he would first have to pick a time length. So if Ben is like, whoop, I guess Ben will be sharing his screen in a second. But if he were to pick, let's just say he believes that the Apple stock is going to be trading at $200 in a 6-month time frame. So he's picking 6 months, that'll be over $200. So he would have to pay a certain amount of money to get the benefit of having it be over that over $200. So then once he buys the option, he has the right to buy 100 shares of Apple if it were to trade at $200. But let's just say Apple were to go down. So instead of going up to $120, it were to go down to $110 over that 6-month time period, and it were never to break that threshold, or that strike price is what it's called, of $120. That means the option would expire worthless, and Ben spent however much money to try and get that option, and he never got the chance to exercise it. The price varies. If it's very close, if you're saying it's $116 and it were to go to $117, that would be very expensive to buy it, because that means that the chances of it going to $117 are very likely. If you're to say Apple were to go to $1,000, the option for that would be very cheap, because they're not expecting in 6 months' time from Apple to go to $116 to $1,000. So let's just say in that 6-month time frame, instead of it going down, it were to go, the stock were to jump to $150. So Ben's strike price was met of the $120, and it's before the 6-month window of it expiring. Ben now has the option, or the right, because he has the option, to buy at $120 versus, even though the stock currently at the day that he exercised the options trading at $150. So in theory, you can make a lot of money, because Ben is now getting the $30 times 100 for the 100 shares of it, and he could buy at the 120 and instantly sell to make a profit of $30 times 100. That's $3,000 instantly, because someone promised him that you can buy at $120, and then he exercises it even though the share is at 150. So like I said, it gets very complex with how the things move, hitting the strike price, being above the strike price, selling it. Ben also has the option, instead of selling it immediately, he could buy at $120 and hold that, because he now owns the shares that he bought at $120 the 100 shares at $120, and he can hold that indefinitely, and now he has stock in Apple. But yeah, it's in a weird way, it's kind of a gamble because you're going against time and you're saying it should hit X price, whatever you set as the price that you want to buy for. So like I said, kind of a complex system. I don't know if you want to expand on anything I said there, Ben.
Yeah, I think so. I think to implement a successful options strategy in your portfolio, I think it can have a place in a portfolio. But me personally, I wouldn't want to invest more than a couple percent of my portfolio into an option strategy, just because of that time element that you were talking about. It I don't want to call it a gamble because there can be quite a bit of an analysis to run the statistics of where the stock price should or shouldn't head. And there's ways to implement an option strategy like an iron condor strategy, for example, where you're buying simultaneous calls and puts. And what you're doing is you're setting up your own little arbitrage where if the stock goes within this specific, wavelength,
Range. Yeah.
you can make money. But if it diverges over that ceiling or that floor, then you lose everything. But there are ways to sort of hedge out risk of a stock without outright owning shares. Because like Chris said, the upside of an option is infinite. And it's pretty steep compared to the intraday or even inter-year moves of owning a specific equity. Owning the option, you can make 100, 1,000 times your money, but the risk is always zero, always.
Yeah.
And owning a stock, you don't have to be right about the timing or the direction. If your thesis is sound, you can just own the company and just know it was a good decision. Whereas options, you got to know a lot of things about where it's headed and where the company's positioned. So there's a place for it, but for an early investor, I would just avoid it like the plague because it's not worth it, in my opinion.
In reading a lot of investment books, I even read for the more seasoned or expert investors, as we'd call them, even them, they say that they trade by no more than 10% of their portfolio in options. And a lot of times it's even closer to 5%. So if you think about that, even the more experts are saying know that it's a big risk. So they keep it very limited at 10% max, probably anywhere between the 1% to 5% range is really what they trade in. Yeah, they can get that long-term upside, but it is very risky for their portfolios.
Yeah, this is the one thing I would recommend where you do the paper trading. If you want to play with options, make it with fake money, honestly, because you don't need skin in the game to let's say you have to put upfront $1,000 to have 2 contracts for Amazon. It's not worth it to learn that. What would you learn by just having 2 options for like a month? You just lost $1,000, and now maybe you're questioning yourself. You realize, wow, I didn't know anything. And I think the best thing to do would to be do a paper trading account with some options, learn that way. That way you're like, oh, like Chris said, when I was doing my first couple of options that I couldn't even sell it because there were no buyers, you'll understand those nuances of the process of option trading. So I would just recommend doing a paper trading account.
Yeah. And there's a lot of great videos on YouTube for doing justice. I'll include those in the show notes. I know that I've learned a lot from 2 different folks. So I'll share in the links. They do much better justice than what we just described. All right, moving on to the next question. All right, so this was actually an anonymous one that was put in. It was kind of 2 different questions. It currently seems that there's a boom in the trading card market happening right now with popular YouTubers such as Logan Paul, Logic, Gary Vee, and LeBron all mentioning it in their social media. Is now a good time to potentially capitalize on the bubble that would be their value? If so, how would one go about doing that? So this is a great question. I know personally, I have been investing in sports cards. I'm a big sports fanatic. I've been investing in also sports cards and also Pokemon cards, back to my childhood. So the way that I kind of look at it is sports card is it's a market in the same way the stock market. It's a less regulated market in the sense that, it's not protected by the SEC or anything like that. But it is still a market nonetheless. And the way that I look at it is there is a bubble right now in the sports card world. It kind of started right when the pandemic hit and sports weren't going on. People wanted to live through sports. So they started, like, a lot of money was coming into the game because, yeah, I can't look at sports, but I can look at stat sheets of, players currently. I can look at legends. I can look at stuff like that. I really enjoy it, but I also realize, kind of like Ben said, with any investment, it can go to zero. If you buy a sports card for $10 or $100, some people could say, well, we don't want to buy it. And if you don't have a buyer, you have $100 sports card that no one wants to buy. You really have $0 and you spent $100. I look at it kind of like, it's not a risk. It's something I enjoy doing, but it's not something I have all my eggs in one basket. Like Ben and I keep talking about, I have my 401k that I'm still investing in. I have my Robinhood account and I have sports cards. I have been successful in selling some of them on eBay. I got really lucky. I bought a bunch of basketball cards, or Panini Prism is really the main brand. And right before the NBA bubble happened, I sold them right when the bubble start kicked off and things were going well and a lot of people were watching basketball, and I tripled my money. I will be the first to say this is not a normal occurrence. It's risky. I got lucky, I would say. I kind of did my research. I kind of assumed a lot more people would be watching basketball in the bubble once it came back. But I bought, full disclosure, I bought Devin Booker, and the Phoenix Suns went 9-0 in the bubble. They missed the playoffs, but Devin Booker was one of the leading scorers, and I got lucky in that regard. And then I also bought Kyrie Irving. So I bought Devin Booker for $46, a Panini Prism ungraded card. I know I'm saying a lot of different words, and I can explain that in further detail, anyone that wants more about it. But ungraded means that it was not sent into a professional sports authenticator, or PSA, or there's a couple different companies, Beckett, SGA or SGS. And they're companies that will literally look at the sports card, look at the condition they're in, and give it a grading from a 1 to a 10. 10 being in excellent, pristine condition, and they put it in a slab so it'll preserve the condition of the card, or a 1 being awful condition, really banged up, bad condition. So basically, I bought a raw Devin Booker for $46, and I bought a raw Panini Prism Kyrie Irving. I bought $46 for Devin Booker and $120 for Kyrie Irving, and I ended up selling them a couple weeks into the bubble. Devin Booker I sold for $140, and the Kyrie Irving I sold for $280. So like I said, tripled my money on Devin Booker, and I like 2.5 times my money with Kyrie Irving. And I really enjoyed it. I like players. I like basketball. The biggest investment right now, and this is just me, and this is, speculative, so don't take my word as gospel, but I know Ben is a big Pokemon guy. Pokemon's 25th anniversary is coming up next year, and I strongly believe that that will be another peak for Pokemon cards. As of right now, like, Logic just bought a first edition Charizard PSA 10 for $220,000. Yes, I know that's the cost of a lot more people's homes. And so he bought one first edition Charizard PSA 10. My one thing with, like, anything with investing is, like, you kind of have to do your research. A lot of people were buying into the Pokemon market of, like, oh, like, if I just buy any first edition card, I'll make a ton of money. That's not always the case. Like, do your research. Charizard kind of sells, but there's multiple variations of Charizard. So if you buy the wrong variation, you could think you're getting a $220,000 card when it's closer to a couple $100. So just be careful. Like I said, it's not regulated. So there, in anything, there's people that are trying to scam you. I'm not trying to deter you. I'm just saying, be cautious. Do your research. Look at other eBay prices for similar cards. Sometimes people mislabel the description. So, you think you're getting one thing and you're getting another thing. eBay kind of has stops in it. So, like, if it was a fraudulent transaction or something's wrong, they will protect you. But at the same time, you got to just protect yourself by doing a lot of research.
Yeah, I think something to be cautious of. I don't like mixing the two opposite words, speculation and investing. So
Yeah.
if someone were to do some research and they wanted to, get involved in sort of the collectibles market, which I am pretty fascinated by. I am interested to see why it's become a bubble the way it has. My first theory is that it's because of the wealth disparity in the country. And I think that wealth disparity was exacerbated by the pandemic. So I think collectibles and these preservations of wealth like art and the wine have just skyrocketed. That's my first inkling, is that rich people are driving up these prices to exorbitant levels just because they can. But if
Yeah.
someone wanted to learn more to participate in these types of markets, how would one do that? What would you recommend people start looking at just to learn some of
Yeah.
these terms, some of the process?
Yeah, so one thing that I would definitely recommend, eBay is actually the best for looking at the market. It's like the equivalent of the stock market for cards. You can look at prices in real time. You can look at real trades that closed, and I can even take you through. There's a lot of good videos as well on this. But when you go into the settings, when you set the filters, you can go for sold and completed items, meaning that it not only sold, meaning that like Ben said he was going to buy my card for $100, but completed means that he actually paid me the $100 and I actually sent him the card. Because sometimes people get mixed if they only put on sold. Ben could have said, "Oh yeah, I bought the $100," but then all of a sudden he can renege and be like, "Oh, sorry, like it's not what I thought it was," or "Oh, my son accidentally bought this on his account," or like
Dangerous.
a lot of times people can give excuses and try and get out of trades, or get out of buying something. So look at sold and completed. They're like two little slider bars that you'd slide on, and you can type in any card you want. You can look up LeBron James, you can look up Patrick Mahomes, you can look up hockey, you can look up Pokemon, you can look up any cards in real time as the trades on the eBay app that have completed. And you kind of have to look at it like the stock market. The more recent trades are more real of what the price is going for right now. Versus if you look at something from 6 months or 3 months ago, you're like, why is this card went from $10 to now $50? It's like because either the player's doing really well, or you can do the reverse. The player's not doing well, the player's injured, the player's contract dispute, the player got in a fight with the team, got in a fight with a coach and not getting played anymore. There's a whole list of reasons why cards move up and down in value. And even in sports, especially in football, it's kind of like, what have you done for me lately? Meaning that, what have you done for me lately in the sense of like, if a player's doing really well, his card will most likely go up. If a player's not doing well, the card will go down. And it can be game by game. It could be week by week. It could be, if they do well for 4 games, the card's continually going up. If they have a bad 2 games, the card's going down for 2 days. So that's just like for researching costs and stuff like that. I'd recommend looking at eBay. And then the other thing, kind of going into social media, looking on Instagram, there's a lot of good card collectors. One of my favorite ones is Card Collector 2, Card Collector underscore Card Collector underscore 2 on Instagram. His name's Ryan Johnson, and he actually does a podcast called Card Talk Pod with 2 people that work for Gary Vaynerchuk, Luge Janu and Tyler Schmidt. So I'm kind of, pitching another podcast here, but I listen to them every week. They drop a new podcast every Wednesday. And they really talk about the ins and outs of the market. They talk about how they look at like investing in sports cards. They talk about flipping. They talking about holding long term. So there's a lot of different things they talk about. So doing research is just kind of looking at content creators that are legit, that make stuff up, or that make content in that, not make it up, but make
Great.
stuff in that realm. Sorry, I hope that helped, and that was kind of a long tangent there.
No, it was good. And I think there's definitely some parallels there where you're talking like, oh, if the player's doing well, or if they're not doing well, then the value will move up or down. And at the end of the day, that's pretty much what stocks are. You're looking at, there's definitely more, it's more data driven, obviously, because they're more of a machine than sort of like the scoring versus like, I mean, I'm not a sports guy, but I think they're very similar in that like, stocks will move up or down based on the perceived value of the business.
Yeah.
Whether, they only report financial information every quarter. So in between there, they're not issuing new financial statements where it's like, oh, this company is changed. It really is a perceived valuation of a business to figure out, how much money are they going to make next quarter, next year, and then into forever. So that's kind of, I think a similar place for like these cards against the players being like the business. They are, you're investing in a card which is sort of like a share of the player's performance. I mean, that's how I'm sort of thinking about it after your explanation. Similar to you buying a share in a company to get access to their profits. The profits are the company's touchdowns. I thought that was a pretty good explanation.
And even just one last point before moving on to the next question. I know, so the Card Collectors group, the Card Collectors podcast of Lou, Ryan, and Ty, they made shirts that said Charizard can't tear an ACL. which I thought was hilarious because a lot of times with sports cards or with just sports in general, you never know when the next injury can happen. You know, if you're an amazing starting quarterback, but if you get so injured that you can't play anymore, you know, the value of their cards will come down. I mean, perfect example, Andrew Luck, quarterback of the Colts. People that don't know much about sports, he was an amazing quarterback, but he ended up retiring at 29, very young age, because he had so many concussions, broken bones, broken collarbone, broken ribs, that him and his wife, you know, collectively came to the decision that, you know, this was so hard on his body. And he basically said, like, you know, I want to be able to hold my kids and grandkids one day. I don't want to be like in a wheelchair. And he ended up retiring, where I full-heartedly, and a lot of the sports community thinks he would have arguably been, you know, one of the best quarterbacks of all time. Without a doubt, just his numbers were there, you know, his intelligence was there, his play style was there, just overall. But he retired early, and a lot of people who bought Andrew Luck thinking like he's going to be the next big thing, which he looked like on paper, you know, ended up retiring because of just too many injuries. So there's a risk where in like Yu-Gi-Oh, Magic, and Magic the Gathering, and Pokemon, you know, they are forever the way that they are. You know, they're not going to be caught cursing into a camera on TMZ. They're not going to be caught, you know, tearing an ACL, and they're no longer allowed to be around. Like, I just think the relevancy of it matters, and I think Pokemon, personally, this is just me, I think Pokemon's going to have a big explosion in the next year and their 25th anniversary. So, like I said, that's something that I'm looking into investing. I hope that all helps everyone. I guess moving on to the next question. So about 15 years ago, I made a sizable around 1K investment in Apple. I currently hold the position full after even several splits, and I'm no longer in danger of ever losing money in relation to my starting investment. How does one determine when to exit with such a long-term investment? Ben, do you mind if I take this and then you kind of add your two thoughts, your
Yeah,
two
go
cents
ahead.
afterwards? So basically, I have four trains of thoughts for this. One, I would leave the investment the way it is, especially now with my thought that Apple is like slowly transitioning more from like a growth stock to a dividend stock. So your initial position, they'll eventually be paying you dividends on a quarterly basis or monthly basis or however they split it up. And I don't know. This is just me, my personal analysis on it. I think it's slowly transitioning from growth and, you know, expanding to more dividend. They are a tech company, so, you know, they can continue to grow, but I think more they're transitioning more to like stable dividend stock. Two, if like that's yeah. So first one's leaving it. Two is you can want to cover your initial investment if you want to sell up to $1,000 worth of gains. In order, you need to factor in capital gains tax depending on your income of, you know, where you fall in the income. You'd either be charged 0%, 15%, or 20% depending on where your income is, and you've had it for over a year now. Just to protect your downside. When you're playing with house money, as one would say. So like if you withdraw $1,000 out, you have your original principal that you invested, but now the rest of the gains that as Apple has grown and with all the stock splits and stuff, you're ahead of the game and you still have shares of Apple. Three, I would sell it when you want to put that towards another better investment. You have so much money probably from that Apple investment that you know, if you're looking at like, oh, this next company's up and coming, but just know that technically with taking out your money out of Apple and you're putting in the next investment, you know, Apple has done really well and kind of given you all those gains. You know, you really want to be confident what your next pick is if you're taking out all your money and putting it into something else. And then four is if you kind of need the money now, whether it's a wedding, you know, your house, medical bills, retirement, you know, if whatever it may be, if you need the money now. So those are the four kind of exit strategies. And I can't really be the one, or Ben can't even really be the one to tell you. It's kind of what you need. So if you want to keep growing it for investments for the long term, for retirement, that's one. If you want to cover your initial investment because you're worried about it going down, you can withdraw the money and then house money is the rest. You know, sell it only if you want to port to something else. You're like, this is the next big thing. I've done my research. I've looked at the financial statements, balance sheets, cash flow statements, you know, or, you know, I want to invest in a Charizard Pokemon card or whatever it may be. Or you just need the money now. You know, things happen in life, medical bills, your house, you lose your job. There's different reasons for different folks. And it's only really you can be the one to determine that. Ben, I don't know if you want to expand on any of
Yeah,
those.
definitely. So I definitely think I mean, I'm not going to pitch a stock today. We can definitely do a stock pitch discussion. I'm a firm believer in that there's still quite a bit of growth in Apple. Personally, I don't see them being, I know they issue a dividend, but I don't think of them as a dividend company. They're I think their payout ratio is pretty low compared to cash flows.
Yeah, it's below 1%, I believe.
You
But
want to look it up in the background?
yeah, yep.
The way that I would boil down those points, honestly, just listening to you describe them, is all it is it's an opportunity cost analysis. Whether it's to invest in something else, buy something if you need the cash now, or if there's a better opportunity out there. So one thing to look at too, I don't know what the portfolio looks like, but it is really quite important to have a diversification standard for your portfolio. There can be those times where you have these companies that just like skyrocket, and something that might have been 3% of your portfolio is now 18% of your portfolio. I think something to keep in mind for yourself is to have these like target allocations of holdings in your portfolio so that you're not putting yourself at too much risk in one company. So let's say Apple became 80% of your portfolio. Well, now you're strictly an Apple investor. Is that what you want to do? I think that's something to be aware of. Maybe you trim that stake down, sell it, hold some cash, look for another opportunity out in the market. Because putting yourself too much at, like what Chris said, don't put your eggs all in one basket. Maintain that diversification and keep things in mind of that pie chart of your portfolio. And if as companies move as they do, you might want to adjust just to make sure it's balanced. And I think the next opportunity cost is you need to factor in the impact of capital gains on your profit, and then what your anticipated return on your next investment will be. It's a delta at the end of the day. And that's the way to think about it. It's an opportunity cost analysis.
Yeah, definitely. All right. So thank you for your question. We're going to moving on to Chris G asked the question talking about Rally Road. It's an app for creating a market for trading shares in classic cards, collectibles, memorabilia, wine through IPOs, and quarterly liquidity windows. I don't know if you want to talk about this at all, Ben.
No, honestly, it really wasn't a question for us. He was just giving us some suggestions. I think that's something I think you and I should probably look at. We talked about the collectibles market. He gave us some resources to look into. So maybe we should put some links and maybe an overview of what those platforms do. Kind of similar to how we'll walk through like Betterment versus Wealthfront versus Acorns. I think that's sort of the brokerage platform to look at the collectibles market. So I'll do some analysis on that. I just think that there's a lot of resources to penetrate that market yourself.
And I guess I'll leave you guys on one last thing. So I know with investing, this is just something personally or something that I kind of follow. Invest in things that you like or you take interest in. Not saying like, oh, like I do have an investment in ExxonMobil. It's not like I'm like, oh, I love, oil and gas or whatever it may be. But I know I heard about Masterworks, which is a company that purchased shares in grade A artwork. And I kind of felt pressured into buying it. So this is just my investment advice. Like if anyone's ever pressuring you to get something, I ended up making a small investment in it. I think it'll do all right. After looking at the financials, it's not going to be as nice of gains as I was hoping for. And I might even sell my shares in that art. I just need to look at it myself. But basically, I was looking for a Banksy painting. He's a cool painter that I like. They didn't have any, but he's like, oh, well, you need to do a $10,000 investment like to get in. And I was like, well, I do not have $10,000 to invest in art. I was like, I can do $1,000. And he's like, okay, I can waive like, the $10,000 minimum. And I was like, well, do you have any like Banksy paintings? It was basically like a sales pitch from this guy that works for Masterworks. And I kind of just felt like very pressured into it. He was like getting frustrated on the call. And I'm like, all right, cool. Like I'll buy $1,000 worth of shares for this one painting. And, I will say to anyone, like you should never feel pressured into buying anything. If it's not something you like or love, or you're interested in at all, like, if you hate Apple, you don't have to buy Apple. If you hate Amazon, you don't have to buy Amazon. If you don't like Tesla for whatever reason, for, personal beliefs, religious, whatever it may be, I would say that you could buy into an index fund. You can buy into sports cards because you love sports cards. You can buy into wine because you love wine. Like find things that you truly do love, and you like do an analysis looking at their cash flow statements, balance sheet, income statements, and all that to analyze the business. But never feel pressured to make an investment into any one thing, or if anyone's like this is the next hot thing, you don't have to go into it.
I think in addition, I think that's hugely important, and maybe we do a book review. But Peter Lynch has this book, One Up on Wall Street, and he sort of narrates the thesis that just the common everyday person like you and me, Chris, have an edge on Wall Street, because if you not only invest in things that you love, but invest in things that you understand, because you'll have your finger on the pulse of the movement of what, it doesn't matter what it is, the asset, card to stock, anything in between. Understanding and also loving it means that you will have maybe an additional level of insights. You might have a layer of understanding about what drives the business or why things might move the way they are, so that one, you're not reacting emotionally, and you can avoid the pressures externally, like Chris just said, of like, oh, this is the good decision. Well, is it because they have some incentive to tell you that, or is it because it's the right decision? I think understanding what you're investing in, and then also investing something you believe in, that, I mean, that at the end of the day is what makes a great decision, is understanding the business and also believing in it is hugely powerful. So that was great advice, Chris.
Yep. So I guess that's it for the episode, guys. Thanks for listening, and we'll catch you guys next week. Have a good one.
Yeah. Before we go, make sure you send us some more questions. Check us out and DM us on Twitter at Amateur Investors. We're on Facebook, Instagram, YouTube. Just look up The Amateur Investors. Our website is now up and running. We're theamateurinvestors.squarespace.com. And our email is theamateurinvestors@gmail.com. See you next week.
Thanks, guys. Have a good one.